What is the secondary market secret on Fidelity for higher bond yields that some investors may overlook? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, many of you who started your fixed income journey with us are familiar with buying new issue bonds, as we've done quite a few tutorials on this topic on our channel over the years, from buying new treasuries at auction to participating in new issue corporate bonds or retail notes on Fidelity and other platforms. Buying secondary market bonds, though, is something that is a bit more complicated, and even more so as Fidelity recently updated their fixed income search screen in a way that many in our community didn't think was initially very intuitive or helpful. That said, there are many advantages to buying bonds on the secondary market, and especially corporate bonds, because of the generally large choices and the potentially higher yields over treasuries and agencies. So, as promised to some of our VIP Investment Club members in one of our recent member lives, here are the 3 topics I'll be covering today. 1. What are the advantages and disadvantages of buying corporate bonds on the secondary market? 2. How can you find and buy potentially higher yielding secondary market corporate bonds on Fidelity's updated fixed income search screen? And 3. What are some ways to increase your chances of success when buying secondary market corporate bonds? Let's dive in now, folks. What are the advantages and disadvantages of buying corporate bonds on the secondary market? So, here are the 3 main advantages of buying secondary market corporate bonds. 1. There's a big universe of secondary market corporate bonds to choose from. For example, at the time of this taping, Fidelity is showing 10,921 secondary market investment grade bonds available for purchase on its platform, significantly more than the 12 new issues it has on offer. Please keep in mind that all numbers in this video are as of the time of this taping on July 16th, 2026. 2. Within this wide product universe, you can find a secondary market corporate bond that matches your specific criteria. For example, here's a sample of the list Fidelity would have given you if you wanted to find a 10-year, non-callable corporate bond with an investment-grade credit rating that paid more than 5.25%. And you could drill down even further if you wanted, for instance, by searching for secondary market corporate bonds that have an A rating or higher only. And this wider choice is not just good for potentially higher yields. It may also allow you to find exactly the bond you want, even though it's not currently offered as a new issue. For example, if you're looking for call-protected corporate bonds, your only option currently is to buy on the secondary market. All the new issue ones that we've seen in recent years, like the 12 that we mentioned earlier on Fidelity's platform, are not call-protected. This Deutsche Bank new issue with a 10-year maturity has the longest time to first call date of 4 years, while other new issues on this list are callable as soon as next year, as you can see here. Moving on now to the 3rd advantage. You can generally find secondary market corporate bonds that yield quite a bit more than treasuries, depending on your time horizon and risk appetite. This also applies to new issue corporate bonds as well. At the time of this taping, on Fidelity's bond yield summary screen, the 10-year treasury is yielding 4.57% versus corporate bonds, which are yielding between 4.99% and 6.78%, depending on the credit rating of the issuer. Do note, though, that while treasuries are never callable, agencies, corporates, and munis can be callable, as we just discussed, and some of the highest yields you see here on this Fidelity bond yield screen for the latter type of bonds may reflect this callability factor. In addition, higher yields for some bonds on the secondary market may also reflect that they can be less liquid than new issues or other frequently traded bonds. So, these are the 3 advantages of buying secondary market corporate bonds: a larger universe to choose from, the ability to choose a bond that meets your specific criteria, and potentially higher yields than treasuries and agencies. Now, let's talk about the 3 main disadvantages of buying secondary market corporate bonds. The first disadvantage is cost. There's usually a fee of $1 per $1,000 par value for secondary market corporate bond purchases online via Fidelity, Schwab, and Vanguard. For new issue corporate bond purchases, there's usually no fee on the leading online platforms. Having said that, you may still find that the specific secondary market corporate bond you're looking for has an attractive enough yield over a new issue for your personal situation, even after factoring in this additional cost of purchase, like some of our VIP Investment Club members have in the past. The second disadvantage is that you can only buy or sell secondary market corporate bonds when the market is open, meaning between 8 a.m. and 5 p.m. Eastern Time, Monday through Friday. For many retail investors, these may not be very friendly hours if you have a job with more or less normal working hours. And the third disadvantage, and probably the one that deters folks the most, is that buying corporate bonds on the secondary market and understanding what it is that you're buying can be complex. As I mentioned earlier, the process is not straightforward. Plus, unlike treasuries, which are guaranteed by the full faith and credit of our government, corporate bonds depend on the financial health of the issuer for interest payments and principal repayment. For those of you in our VIP Investment Club, please do revisit our 4-part member mini-series here in the Member Zone from earlier this year if you want a refresher on corporate bond investing and some of the key items and questions to be mindful of. And if you're interested in joining our daily conversations and being the first to know about higher yielding opportunities and topics like today's, which were covered quite a while back in our Member Zone, come on over and join our growing member community in our VIP Investment Club. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join us today. I've also linked everything below this video for you. So, let's say now that you decide that the advantages of buying secondary market corporate bonds may potentially outweigh the disadvantages, and that you're ready to perhaps add some to the boost part of your portfolio. This still leaves the question of how to go about doing this in real life, which brings us nicely to the next part of today's discussion. How can you find and buy potentially higher yielding secondary market corporate bonds on Fidelity's updated fixed income search screen? Here we are on my Fidelity account summary screen. Let's click on News and Research, and from the pull-down menu, we'll select Fixed Income Bonds and CDs. This will take me to the usual Fixed Income Bonds and CD screen that many of us are used to seeing. Let's scroll down now to this section with the overview of the bond yields. I'm going to go with the 6.78% yield for the 10-year corporates with the Moody BAA and S&P BBB ratings, meaning the bonds that I will be showing you shortly are all investment grade, although at the lower end of the range. And if you're curious as to why I chose this time horizon and credit rating, the primary reason in this instance is because it gives me the best selection of corporate bonds with a wide variety of pricing options to use for this tutorial. You should, of course, choose the time horizon and credit rating that best suits you. So when I click on this 6.78%, I get to this Find Fixed Income Product screen. Up here, I can click on Product Type and add different types of bonds if I want to from this box that pops up. Or I could click on this filter box to search for bonds that are call protected or that have a specific maturity, credit rating, and so on. I'll leave everything as is to make things a bit easier and just go with this standard list that Fidelity gives me of BAA and BBB corporates with roughly 10 years to maturity sorted from highest to lowest ask yield. And on this table, we can see that one of the nicest new features of Fidelity's upgraded fixed income search experience is this call protected column. In the past, the call protected column just gave you a simple yes or no, but no details. Now, it immediately shows you the first call date for any bonds that are not call protected, which saves a fair bit of time in my mind. And as a reminder, these numbers here show the maximum quantity available at these ask prices and yields here. And these numbers in parentheses are the minimum purchase quantities required to get these ask prices and yields here. So, for example, if I wanted to buy this United Mexican States bond to get this ask price of $99.173 and this ask yield of 6.112%, I would need to purchase a minimum of $200,000 par value. If I were to buy less than this minimum of $200,000 par value, my ask price would likely be higher and my ask yield therefore lower. Or I may just not be able to buy the bond at all if there's no dealer willing to sell at the lower quantity that I wanted. Now, I don't have $200,000 for this tutorial. So we're going to go with this Oracle bond here for today, which is a minimum purchase quantity of only $2,000 par value at this ask price of $81.326 per $100 par value. Remember that for bonds, purchase and sale quantities are always quoted per $1,000 par value, whereas the price is quoted per $100 par value, which is admittedly not very consistent and can be confusing at first, but that's how the market operates. So this $81.326 ask price on the Oracle bond gets us to this yield of about 6.4%. Let's click on depth of book now so that I can show you why I chose this bond. Here's the screen that appears next, showing the long list of ask prices, meaning that the depth of book is fairly robust, that there are a number of dealers who are offering to sell this Oracle bond. Or, in other words, there's a fairly liquid market for this bond at the time of this taping. You might also notice that in the process of clicking through to this depth of book, the price here has already moved down a few cents to $81.313 from $81.326 previously. That's the secondary market for you though. Prices can sometimes move quickly. Remember this depth of book because we will return to it later on in this video. So, going back to this original screen from before, let's click on the Oracle bond, which will bring up additional information on this bond in the next screen. Here's the coupon, the maturity date, and the CUSIP. And here again is the maximum quantity available and the minimum purchase requirement needed to get this ask price and this ask yield. And if we scroll down, there are more details below about the bond here, such as the ratings from S&P and Moody's, when the next call date is and at what call price, where this bond sits in the corporate bond hierarchy, when the next coupon date is, and whether the coupon is fixed or not. Scrolling down further gets to this section on redemptive features, meaning call features. So for example, this bond is not call protected, which we already know, and I could click here if I wanted to see the full call schedule. And at the very bottom, there's a box that has more specifics in the event that the bond is convertible into equity, for example. This Oracle bond is not a convertible bond though, so this box does not matter in this case. Now, let's scroll back up to the very top and click Buy to keep going with this tutorial. And here's the trade screen that appears next. Here I'll choose the account that I want to purchase this bond in, and then scroll down a bit so that we can see the full screen below. Next, I'll confirm that all the bond information is correct, including the ask price, the ask yield, and the minimum ask quantity. And under quantity, I'll enter 2 for the $2,000 par value that I want to purchase. The limit price per $100 par value here is the same as this ask price here. And I'll leave it as fill or kill for this tutorial, meaning that if the dealer cannot fill my order of 2 bonds or $2,000 par value completely at this limit price, the order will be canceled quickly. More about that later. If you want, you can also choose a day order and enter the maximum price that you're willing to pay per $100 par value. Fidelity will then try to fill the order until the close of market. And if they cannot do this, then the order will be canceled automatically. For the sake of simplicity, let's leave this as fill or kill though, and hit preview order, which will take me to this next screen where I'll need to reconfirm everything one more time for the bond that I'm buying today. Let's scroll down a bit. Here I can see again that I'm buying 2 bonds, meaning $2,000 par value of this CUSIP. This is a limit order at the price shown here before fees of $81.313 per $100 par value. And this is the actual price per $100 par value that I pay of $81.413, which includes Fidelity's markup or fees of $1 per $1,000 par value, giving me an effective yield of about 6.396%. And here at the bottom, I can see that my estimated order value of $1,628.69 includes the $2 markup, Fidelity's fees for secondary market bond purchases, and 43 cents of accrued interest. When you buy on the secondary market, you should have a little buffer in your account for fees and accrued interest. So, if everything is correct here and I want to proceed, I'll click Place Order. Now, you might think that I'm done, and in the best case scenario, I could be done if my order goes through as planned. But this isn't always the case, which brings us nicely to the next part of today's discussion. What are some ways to increase your chances of success when buying secondary market corporate bonds? So, it's important to know that just because you place an order for a secondary market corporate bond and receive confirmation from Fidelity that they've received your order, this does not necessarily mean that your purchase was successful. Bond orders sometimes get canceled. And the reason for this is that the bond market for unlisted bonds is made up of a decentralized network of individual dealers. It is not a centralized exchange like for listed stocks. In addition, not every broker will have a relationship with every dealer, although there may be a good degree of overlap for the larger firms. The ask prices shown here, for example, and even here on my preview screen before I place my order, they are generally the best price and yield combination. They are also just quotes from the dealer that may be indicative only and not binding. Another way to look at this is that from a legal point of view, it is you who makes the offer to buy or sell a specific bond at the best quoted price. And the dealer who quoted that price can then either choose to accept it or not. And the dealer may not accept an order for a number of reasons, but the typical ones are because 1. The best prices can sell out fast. 2. Prices have changed on the market in the interim. Or 3. There's a fundamental mismatch between your order and the dealer requirements, which we think may sometimes just mean that the dealer changed his or her mind. Large brokerages such as Fidelity usually treat secondary market retail bond orders as fill or kill limit orders, with say a 15 or 20-minute time window for processing. If the dealer who quoted the price does not accept your full order within that time frame, it gets canceled. Your order will not usually go automatically to the dealer with the next best price, unless you set a higher limit. In summary, bonds do not generally trade on the secondary market as easily or friction-free as stocks, and that may not only be true for corporates, but even for treasuries. When the yields on long-term treasury bonds peaked in mid-May, I had to place my orders multiple times on the secondary market before I was able to get the 20-year above the 5.15% yield that I was shooting for. My first 3 orders actually got canceled because bond prices were moving faster than usual on the particular day that I was buying. As we told our VIP Investment Club members, if your secondary market bond order gets canceled, just keep trying if it's a bond that you really like at a price and yield that you find attractive. There are ways to increase your chances of success on the secondary corporate bond market, though. And to show you one of the simplest ways of doing this, we have to go back to this depth of book for the Oracle bond that we showed you earlier. Remember that the ask prices and yields here are ordered from best to worst, meaning this price and yield here on the very top is the best one on offer. And given that this dealer only has a maximum of 8 bonds available at this price yield combination, this tells me that this may be a price yield combo that sells out quickly. And indeed, the first 2 times we tried to place the Oracle bond order for this tutorial at the best ask price in the depth of book, we couldn't even get past this ordering screen because the price was already gone. Here's an example of the error message we got in those instances. So if you find yourself getting a similar error message, or if you find that your orders keep getting canceled after you've placed them, the easiest way to rectify the situation is to go back to the depth of book and try to buy from a dealer further down on the list directly, like this one here, for example, in the case of Oracle, who also has a minimum purchase quantity of 2. The good news for everyone here is that our VIP Investment Club members who embarked on their secondary market corporate bond investing journey with us did manage to successfully buy their first corporate bonds on the secondary market pretty much at the rate they wanted after a bit of guidance and encouragement from me, Marcus, and our other members who've gone through this themselves already, and I'm sure you will too. And as always, if you're interested in joining our daily conversations on topics like this one and other higher yielding alternatives such as preferred stocks, dividend funds, and international bonds, come on over and join the growing member community in our VIP Investment Club. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more and join us today. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again soon with more brand new wealth building content for your financial journey.